When the pandemic hit and the market crashed,
at first I was sort of freaking out.
I started losing money and I panic sold.
It's money I was willing to kind of lose and play around with.
I put $5,000 in, and right now I'm currently at $9,200.
Everyone you see here started investing in the stock market in 2020. They're part of the surge in so-called retail investors who bought stocks for the first time last year. Retail investors are non-professional investors managing their own money. And everyone here is mostly betting on individual stocks, instead of safer assets like index funds and ETFs, which are diversified baskets of securities that reduce risk.
It's been a wild ride of holding Moderna,
Target, Procter & Gamble,
Pfizer, and Inovio,
Activision, Blizzard.
Tesla stock has done really well for me, and if I sold it all right now, I would have enough money to pay my rent for the next couple of years.
I do feel like there is a little bit of a mania going on in individual stock investing.
I am focused on this issue of retail euphoria. I do worry that retail investors do not understand that trees don't grow to the sky.
Just a few years ago, the discussion was, well, these young investors have seen how their parents have struggled with investing in the market, with home values. These young investors are so risk averse. And now we're sort of at the opposite extreme, where there's a lot of hand wringing over whether young investors are actually taking too much risk in their portfolios.
The risk of focusing too much on individual stocks is if a stock falls, an investor who isn't diversified could lose a lot of money. Here's what experts say beginning retail investors should be doing instead.
There are more retail investors participating in the market than ever before.
In 2020, retail investors were responsible for about 20% of the shares traded on the US stock market, up from about 15% in 2019 and 10% in 2010. That's a trend accelerated by the rise of commission-free trading and the pandemic. With people stuck at home under lockdown, many had more time on their hands. And the market crash in March 2020 looked like an opportunity to make some money.
I was one of the employees, one of the millions of employees in California that got laid off. And I think just when you're at home, your mind starts to explore. You start wanting to do things that you never had the time to do, and you start wanting to take a risk. For me, stocks were one of that risks that I took. There's a certain amount of pleasure you get when you see an individual stock that you picked shoot up.
Like Asan, many new retail investors have piled into names they're familiar with, high-profile stocks often discussed on the news. And they aren't necessarily diversifying into safer investments like index funds and ETFs.
Right now, I haven't learned how to diversify my risk yet. I don't know too much about index funds.
Personally, I'm not really diverse, just because I'm brand new to this.
I have not yet looked into ETFs or index funds. I mean, I don't know what an ETF is.
Experts say retail investors are taking on more risk than they used to.
Conventional wisdom insisted that only a fool would try to pick individual stocks. Too easy to be wrong. That thesis only grew more convincing after the financial crisis. In the last 8 months, though, that conventional wisdom has been stood on its head by a new generation of investors who came of age after the rise of commission-free trading. They're much more optimistic than the older generation.
After all, stock picking paid off for many retail investors in 2020 as the market rebounded after its March crash and soared to record high after record high. But those gains may not last. Experts are concerned that stocks are overvalued, especially the major names popular among new retail investors that drove much of the market's performance in 2020. When the dot-com bubble popped in 2000, overvalued internet stocks suddenly plummeted in price.
Investors lost a lot in the late 90s, and especially in the early 2000s, where they had shoveled all of their money into a narrow group of companies. They wouldn't hear about diversification. And lo and behold, we went on to have, from 2000 through 2010, what's often been called the lost decade in stocks. US stocks really didn't gain ground at all.
For most beginning investors, experts say to avoid buying and selling individual stocks because it's too risky.
A better way to get started in investing is actually really boring. Buy a plain vanilla index fund or maybe a target date mutual fund. Keep it boring, keep it simple. It's not a sexy message, but it's one that's been incredibly effective for a lot of investors for many years.
Experts recommend automatically investing a set amount of money into these assets on a regular basis. For instance, each month. That's what many Americans already do with their 401ks. This method is called dollar cost averaging.
So if the market is going up, okay, you're buying more and more and more expensive. That's the price you pay for the opposite, which is buying cheaper and cheaper and cheaper. So that's how we hedge this notion that we cannot time the market.
We're not exerting active oversight of our investment selections. We're not even spending much, if any, time thinking about when our contributions go in. Turns out those are really great things to do for your long-term investment plan. For investors who have done really well in individual stocks and are looking forward to making sure that they can continue to do well into the future, one idea is to take your winnings and put them into a more broadly diversified portfolio. Or perhaps if you are thinking about investing in some boring index tracking mutual funds with the bulk of your portfolio, maybe carve out kind of a mad money portfolio of individual equities. I think that that can be a good way to kind of satisfy your desire to participate in individual stocks while also ensuring that your net worth and the bulk of your investment assets aren't tied up in the fortunes of just a few companies.
Benz recommends allocating just 5 to 10% of your portfolio to taking more risk with individual stocks. That's, of course, if you've already ticked off other financial milestones like paying off debt or building an emergency savings fund. That's what Amin Gill is doing. She's playing around with stocks using extra savings that she can afford to lose.
On one part, I have a long-term investment with my Roth IRA and my 401k. And then on a kind of second part, I have investments that are short-term through a brokerage account. Yeah, so it's really fun. I think that's what's really made me into investing, is the fun I'm having with it.
The market may have rewarded having fun with stock picking in 2020, but going forward, experts say it might pay off more to take the boring approach to investing and buy an index fund instead.